Federal Reserve Governor Lisa Cook has issued a severe economic warning regarding the United States economy. Cook stated today that the balance of risks has drastically shifted toward inflation. According to a highly significant report from Reuters, this shift is entirely driven by the ongoing Iran war. The announcement marks a fundamental realignment in the monetary policy posture of the United States. Central bankers are now actively modeling the financial fallout of the escalating Middle Eastern conflict. Reuters reports that the violent disruption of global energy supplies is the primary macroeconomic catalyst. The Federal Reserve had previously signaled a trajectory of economic stabilization and potential rate cuts this year. However, the kinetic reality of the Persian Gulf has completely shattered those optimistic economic models. United States officials suggest that the prolonged conflict is generating undeniable and systemic inflationary pressure. Governor Cook's statement is the first official acknowledgement of the war's direct domestic financial cost. The clear implication is that military escalation abroad absolutely guarantees economic pain at home. Financial markets reacted with immediate, high-velocity volatility following the release of the Federal Reserve's assessment. The prospect of higher interest rates for a significantly longer duration is now the baseline market scenario. This represents a profound secondary consequence of the administration's current maximum pressure military campaign. The central bank is now officially fighting a monetary war generated entirely by foreign policy decisions. To understand how military operations in the Persian Gulf directly dictate your personal financial future, you need this analysis immediately. Subscribe to our reporting network right now, turn on notifications, and leave your strategic assessment in the comments below. To fully grasp the magnitude of this warning, one must analyze the mechanics of global energy inflation. The war with Iran is not simply a localized military engagement confined to the Middle East. It is a profound macroeconomic shockwave striking the foundational pillar of the entire globalized economy. When military operations threaten the Strait of Hormuz, the price of internationally traded crude oil inevitably spikes. This is not a temporary logistical disruption that the Federal Reserve can simply ignore or wait out. Energy costs act as a universal, inescapable tax on every single supply chain on the planet. According to economic analysts, diesel prices directly dictate the cost of agricultural production and maritime shipping. When fuel prices surge due to geopolitical instability, global food and retail prices follow almost immediately. Reuters noted that the central bank is now forced to react to decisions made by military commanders. The Pentagon's targeting matrix in Tehran effectively dictates the core inflation rate for the American consumer. This structural reality exposes the absolute myth of a contained, consequence-free foreign military operation. The United States possesses the undeniable capability to project overwhelming military force across the globe. However, it cannot legally or financially shield its domestic economy from the inflationary blowback of that force. Governor Cook's warning confirms that the economic insulation of the United States has completely failed. The monetary policy of the world's largest economy is now tethered to the violence in the Persian Gulf. Prior to the escalation with Iran, the global financial system operated on one specific, comforting assumption. Markets universally expected the Federal Reserve to begin systematically lowering interest rates this year. This expectation drove equity valuations, corporate investment strategies, and consumer borrowing models across the West. The outbreak of war in the Persian Gulf has reportedly annihilated that entire economic narrative. With the balance of risks shifting rapidly back to inflation, rate cuts are effectively off the table. Financial institutions are rapidly recalibrating their risk assessments to account for sustained, punitive interest rates. A report from Reuters indicates that the central bank is deeply concerned about permanently entrenched inflation. If energy prices remain elevated due to the conflict, core inflation metrics will inevitably and persistently rise. To combat this, the Federal Reserve must maintain or even increase borrowing costs for American citizens. This creates a brutal economic paradox. for the current administration's domestic and foreign political strategy. A war designed to project American strength abroad is systematically destroying purchasing power at home. Every day, the conflict continues. The probability of a severe domestic economic recession increases significantly. Wall Street is reportedly demanding absolute clarity on the administration's military exit strategy from the Gulf. However, military planners appear locked into an escalation trap with no immediate diplomatic off-ramp visible. The central bank is essentially held hostage by the unpredictable and violent timeline of the Middle Eastern war. The inflationary impact of this war is not an accidental byproduct of the ongoing military conflict. It is the deliberate, calculated result of Iran's asymmetric defensive strategy against the United States. Tehran clearly understands that it cannot defeat the American military in a conventional, kinetic engagement. Therefore, the Iranian leadership has effectively weaponized the global energy market to offset American supremacy. By threatening vital oil infrastructure and maritime routes, Iran generates massive, uninsurable systemic risk. This geopolitical risk instantly translates into the exact inflation that the Federal Reserve is now battling. Economic analysts believe this is a highly sophisticated form of economic warfare executed perfectly by Tehran. The Islamic Republic is reportedly using the extreme vulnerability of the global supply chain as its primary shield. They calculate that sustained, crippling inflation will eventually fracture the political resolve of the American electorate. Historically, prolonged energy inflation has destroyed the political viability of multiple United States administrations. Reuters noted that the central bank's stark warning validates the lethal effectiveness of this Iranian strategy. The United States is forced to absorb immense domestic financial damage to prosecute its overseas military objectives. This dynamic fundamentally alters the cost-benefit analysis of the entire American maximum pressure campaign. Hitting Iran harder militarily simply produces significantly harder economic hits on the American middle class. The escalation trap has effectively merged the battlefield in Tehran with the bond market in New York. The abstract warnings of the Federal Reserve carry immediate, devastating consequences for regular working citizens. When Governor Cook states that inflation risks have shifted, she is describing a permanent tax on existence. Higher interest rates mean that mortgage payments for the average American will remain prohibitively expensive indefinitely. Credit card debt, auto loans, and crucial small business financing will become increasingly and rapidly unsustainable. The war in Iran is reportedly being financed directly through the rapid degradation of domestic living standards. United States officials rarely articulate the direct link between military deployments and domestic borrowing costs. However, the hyper-globalized nature of commodity markets makes this connection absolute, immediate, and unavoidable. A report from Reuters suggests that consumer confidence is already beginning to erode at a dangerous pace. If the war persists and inflation entrenches deeply, domestic consumer spending will inevitably and catastrophically collapse. This consumer collapse is the precise mechanism that transitions a geopolitical crisis into a severe domestic recession. The administration is reportedly gambling that a swift military victory will stabilize the markets in time. But the operational reality of this protracted conflict currently shows no signs of a rapid, clean conclusion. Instead, the war is expanding, drawing in regional allies and threatening much larger global energy nodes. The Federal Reserve's public pivot is a clear signal that they do not expect a quick resolution either. They are preparing the entire financial system for a protracted, inflationary, and highly destructive war of attrition. The historical parallels to this current economic predicament are worth examining with extreme analytical urgency. The global economy is facing a scenario remarkably similar to the geopolitical oil shocks of the 1970s. During that era, Middle Eastern conflict produced an energy crisis that fundamentally broke the Western economic model. It generated years of stagflation, a toxic combination of stagnant economic growth and runaway price inflation. The Federal Reserve was ultimately forced to raise interest rates to unprecedented, economy-crushing levels to stop it. Governor Cook's warning suggests that the central bank is terrified of repeating that exact historical nightmare. Today's global economy is arguably even more dependent on the seamless, uninterrupted flow of international logistics. A disruption in the Persian Gulf today cascades through the global system faster than it did 50 years ago. The United States is discovering that military technology has advanced, but macroeconomic vulnerabilities remain entirely unchanged. You cannot bomb inflation out of existence, nor can you intercept rising prices with a missile defense shield. The administration's strategic planners reportedly failed to adequately model this specific macroeconomic blowback before escalating. Now, the Federal Reserve is tasked with cleaning up the financial collateral damage of a foreign war. This internal contradiction is the defining feature of American strategic decision-making in the 21st century. The cost of global hegemony is now being billed directly to the American consumer through sustained inflation. The war for the Persian Gulf is effectively being paid for by the devaluation of the United States dollar. The situation currently unfolding exposes a profound and fatal vulnerability in American grand strategy today. The United States undoubtedly possesses the military capacity to dismantle adversarial states across the globe. However, the globalized economy ensures that the financial blowback cannot be contained territorially or mitigated easily. Governor Cook's stark warning confirms that the Iran war has become an immediate domestic economic crisis. The strategy of maximum military pressure has inadvertently triggered maximum inflation for the American consumer. Iran's ability to manipulate global risk premiums serves as a highly effective and asymmetric economic deterrent. Military escalation is now mathematically and undeniably linked to the erosion of American economic prosperity. The geopolitical landscape in the Middle East continues to strictly dictate the financial stability of the world. The Federal Reserve has officially and publicly drawn the connection between the war and domestic inflation. The effectiveness of further military action must now be heavily weighed against the certainty of economic pain. For now, the situation remains highly fluid, and the potential for a deeper, systemic recession is imminent. Uncertainties remain regarding how the administration will balance its military objectives with this harsh monetary reality. To truly understand the cascading consequences of these monumental decisions, ensure you follow our continuous coverage. We analyze the critical intersection of military force and global economics to bring you the unvarnished truth. Thank you for your time and for seeking a deeper, more analytical perspective on today's defining global crises.